So if the cost of capital goes down, then that's positive for them. So I think we're seeing it. You're seeing flows into equity markets out of things like money market funds. I mean, I think the market, we saw it in the equity markets in China. I think it responded really favorably. It was clear. It was a clear message because it was coordinated effort in reaching all parts of the economy to really create stimulus. There's a real desire, obviously, for foreign investment into China, foreign investment into Hong Kong, and you can see the types of programs and policies that they've had and continue to roll out, that's very important to them. So that's going to always position Hong Kong as a critical player.
Franklin Templeton Investments is a leading global investment management organization that traces its roots back to 1947, when it was founded by Rupert H. Johnson in New York. Today, Franklin Templeton manages over $1.5 trillion in assets as of recent reports, serving investors in more than 150 countries.
Hi, Jenny. Thanks for joining us.
It's great to be here.
As we head into the rate cutting cycle, interests are coming down on cash and money market funds. How will this affect asset management industry in terms of market liquidity and capital flows?
I think because there's obviously been a lot of money that's been stored in cash and money market funds, right? And you've been yielding 5% returns. As that becomes less attractive, it should go into the alternative investment. So equity markets, fixed income markets, wherever. If you look since 1980, from the beginning of kind of the peak rates where they start cutting the cycle, the S&P 500 returned on average of 13% after the beginning of rate cuts, right? So it's good for equity markets. It's actually good for growth stocks because obviously growth stocks are based on future earnings. So if the cost of capital goes down, then that's positive for them. So I think we're seeing it. You're seeing flows into equity markets out of things like money market funds. And then I think globally, the interesting thing is pretty much most countries are cutting rates. So as long as everybody cuts rates together, it doesn't kind of change the flows that much, with the exception of Japan, which is raising rates. But as long as the economies in like the U.S. stay strong, I think the dollar is going to continue to be pretty strong, even though with rate cuts that can often be negative for the dollar, but because those other economies are cutting as well.
As we know, China is the world's second largest economy, and there are a lot of discussions or even debates on Chinese economy and Chinese markets. So what's your perspective on that, as Chinese government has rolled out a series of stimulus measures in recent months?
Yeah, I mean, I think the market, we saw it in the equity markets in China. I think it responded really favorably. It was clear. It was a clear message because it was a coordinated effort in reaching all parts of the economy to really create stimulus. I think that the market's waiting for additional stimulus to come in. There's kind of an expectation of, okay, when's more coming? But I think there's some unique things. I just heard about a program, which is trying to stimulate the domestic consumer, which oftentimes hasn't been part of the stimulus packages in China, with these kind of voucher programs that, if you can apply for it or something and you get a voucher and it says if you go spend money at a restaurant, the government will give you X percentage back. So those types of things will, really, if they can stimulate the consumer in China, that's going to be very positive for the markets. And China has got such a high savings rate that if they can stimulate people to start pulling out of their savings, it's going to be very positive for the market.
So this will be a key catalyst?
I think so, yeah.
As we know, China's mutual market has grown rapidly, and the net asset value has hit 32 trillion yuan by the end of September, as Chinese investors do more to diversify their investments. So how do you see this? As we know, Franklin Templeton has an onshore joint venture for $2 for more than 2 decades. So what's your plan or strategy to tap into this enormous growth and wealth?
Yeah, well, I mean, that's kind of what we do, right? Is creating, good investment vehicles for people to be able to participate in the markets. We've been in fact, I think it was last Friday, we celebrated 20 years in our joint venture, Sealand Franklin Templeton joint venture in China. It's been a really good experience for us. And you have to keep up with the market as it started out as mutual funds. Now there's ETFs, so we have to look at that kind of opportunity. But to be able to provide great products within China is important, but also having local feet on the ground or investment people, they can feed ideas and knowledge and insight into our global teams as part of, say, the emerging market team or the global equity team. So it's been really good, and we've had long-term stability of our investment teams within our joint venture. So we're very positive on it.
So are you still committed to this?
We are still fully committed. Look, I am always surprised by anybody who would say they're not committed. The reality is China is the second largest economy in the world, and it's not going to change in that position for a very long time. It's going to be, continuing to grow. And as a multinational firm with investors in 160 countries, we have to have experience and knowledge and invest in the second largest economy in the world.
There have been a lot of discussions, debates surrounding Hong Kong's status as a global financial hub. So what's your perspective on that as a global leading asset management firm that oversees $1.7 trillion?
Well, so first of all, we've just celebrated 30 years of being in Hong Kong. We actually first started investing into China A shares through Hong Kong in 1987. So it's been a long time. I think, look, the reality is this concept of one country, two systems, with Hong Kong being the gateway to China, is really important, right? And again, China is the second largest economy. Hong Kong's ability to help with capital flows, there's a real desire, obviously, for foreign investment into China, foreign investment into Hong Kong, and you can see the types of programs and policies that they've had and continue to roll out. That's very important to them. So that's going to always position Hong Kong as a critical player. I think it's the largest asset management hub in Asia. I think it's the second largest private equity hub versus mainland China, I think, which is number one in Asia. So it's obviously a really important financial center.
So this will not change given the geopolitical the landscape or all these macro trends are reshaping the industry?
Well, I think that's exactly it, right? The macro trends are reshaping things, but the major economies are still the major economies, right? If you end up with tariffs, say increased tariffs in the U.S. against China, it's going to be on specific sectors. You've already seen the mainland Chinese manufacturing starting to diversify their supply chains. So the businesses are very adept at figuring out how to manage and navigate kind of the rough waters that the political environment can create. But the reality is China continues to be an incredibly important and strong country and market, and Hong Kong is the gateway to that.